Hello. I'm taking this opportunity to explain depreciation before under asset disposal. So I'm explaining depreciation on this video. Okay. So I will break the depreciation into three assets. I will break the depreciation into three assets. First of all, let me start with I will break it. I will have an old asset. Let's say it's a machinery. The word asset, yeah, but let's say it's a machinery. So then I will break it from the old. Where number one, we have an old machinery. Number two, we will have a sold machinery. Number three, we will have a new machinery. Let me explain. We have an old machinery. Sorry, the camera. So we have old machinery, sold machinery, new machinery. How are we going to see that this is a depreciation for the old machinery? In the question, they will give us the opening balance for the asset, for the machinery or for the vehicle, for the equipment. So they will give us the opening balance. Let's say in the statement they might say 1 January 2023, the opening balance for the vehicles or the account, the balance for the vehicles, let's say was 248,000. Was 248,000. 1, 2, 3. So that 248,000, I break down it as an old machinery. I'm breaking down it as an old machinery. All right, number two, I will tell you how to calculate the depreciation, don't worry. So let me indicate that this is depreciation. Depreciation. All right. So then you will read the information there. Somewhere, somehow, they will tell you that we sold a machinery which was originally bought on this year. Maybe they say the cost price was 300,000, for example. So maybe the cost price was 300,000 of the sold machinery originally. They will tell you that we sold this for original for 300,000. It was costing 300,000. We sold it for. If they say we sold it for 79,000, blah blah, they mean that 79,000 is the amount that we received when we sell the asset. Please get this. If they say we sold machinery A, which was originally purchased 1 January 2020, this is an example, 1 January 2020, and we sold it for 70,000. So if they say we sold it for 70,000, which means for 70,000, the 470,000 is what we received when we sold the asset. But the original cost is that 300,000. They will tell you that which was originally cost 300,000. So that is the sold machinery. So then we have another machinery which is called new machinery. They will tell you that 31 May, for example, 31 May, the company bought a new vehicle which was costing, my example, which was costing 365,000. So then now we have these three machineries. Okay, let me write the date. So this one very obvious, the opening balance they gave us. So we sold this one. Let's say the date we sold it 31 March. We sold this one 31 March. Let's say we bought this one 31 May. These are my examples to make you understand. So we sold this 31 May. Okay. Let's say we are using a straight line method. A straight line method. Let's say we're using a straight line method. Number one, we're using a straight line method. So how are we going to deal with this one? Let's first calculate the new vehicle for just in case, and our percentage for depreciation is 20%, for example. So how are we going to calculate the depreciation for the new vehicle? We are going to take the original cost, 365, 1, 2, 3. Then you multiply by your percentage. How many percent? Is 20%. Remember, it's a straight line. It's 20%. And then Sibenayo, this vehicle, we had this vehicle from May. So calculate from May to December. How many months? Is May, June, July, August, September, October, November, December. This is 7 months. Then you write 7 over 12. It's 7 over 12. Then you get your depreciation for the new vehicle. How are you going to calculate the depreciation for the sold vehicle? You do the same, 300,000 multiply by 20%, multiply by how many months did you have this machinery. We had this machinery from January to March this year. We had it from when we sold it March. They are telling us that we sold it March. So we had this machinery from January until 31 March. How many months? Is January, February, March. It's 3 months. So then it's 3 over 12. Then you will get your amount for the sold depreciation. Then now, let's come and calculate the depreciation for the old machinery. How are you going to calculate the depreciation for the old machinery? Please allow me to use this space because Aksana space gala. So the old, please, I'll use this space. The old machinery, it was costing how much is 248,123. So in the next video, I will be doing an example, a question paper. So this is the old machinery. Remember, how are you identifying the old machinery? They will tell you that they will give you the opening balance. If they didn't give you an opening balance, which means we have two depreciations. We have the depreciation for the sold and for the new. But if they gave us an opening balance, which means that opening balance, we treat it as a what? As an old machinery. As an old machinery. So then how are you going to calculate the old machinery? All right. You are going to say 248. 248. 1, 2, 3. Minus the sold machinery. How much the original cost is? How much is 300,000? Multiply by your percentage, 20%. Multiply by 12 over 12. All right. The question is, why are you subtracting the sold machinery, the 300,000? Okay, simplest answer. I'm subtracting this 300,000 from 248 because good one in this 248,000, 300,000 is included there. So I'm subtracting it because it is included. Meaning I want a depreciation for the cars, not for the other cars, excluding the sold car, So I will subtract the 300,000 from the 248,000 because in this 248,000 there is this 300,000, and now I don't want a depreciation for this 300,000 because already I've calculated the depreciation for the 300,000. So I'm subtracting it. I'm removing the 300,000 from this 248,000. So then how much I'm going to get? So that amount you're going to get, then you multiply by 20%, then 12 over 12. You know, so it's 12 over 12. So in other question, they will tell you, Uti, we sold this vehicle at the last day of the year. So if they sold the vehicle at the last day, like 31 December, if they sold it 31 December, we are not going to subtract this 300,000 from this 248,000. Why? Because it was there the whole 12 months. It was there the whole 12 months. You know, this 300,000 is sold 31 March. 3 months. So we had this vehicle for 3 months. That's why we subtracted from this 248,000. But if they say we sold it 31 March, 31 December, said then we are not subtracting it here. Why? Because it stayed this 12 months. Remember, it's 12 over 12. So we are subtracting if it was sold during the year. So we will remove it. Yeah. If it is during the year, is March, is April, we'll remove it from this cost. I hope this one, you should understand this one. You should understand this one. So if you don't understand it, try by all means to understand it. If the vehicle was sold in the middle of the year, the sold vehicles, then we are subtracting that amount. So if it was sold at the last day of the year, 31 December, because it stayed these 12 months, so then you are not subtracting it. So this is how you're going to get your your answers. So you do the same accumulated depreciation diminishing method. It's still one and the same method. So just there you will be given a accumulated depreciation. So the formula for for what do you want to say? Okay, the formula for diminishing method, it says cost. It says cost minus accumulated depreciation multiply by your percentage. They will give you multiply by n over 12. Multiply by n over 12. So then you do the same thing with EDA. If you want to want the new one, then you take your cost, you multiply accumulated depreciation, you do everything that I have done. But now the difference will be like you subtract the accumulated depreciation here. So I hope these videos will help you. Thank you.